Welcome to your study guide for the California Property and Casualty Exam. Mastering the fundamentals of property insurance separates confident test takers from hesitant ones. This guide covers property basics, walking you through property and casualty coverage, understanding insurable interest, policy forms and perils, direct versus consequential losses, valuing property losses. And don't forget, our website offers free exam guides along with practice questions designed to help you ace the test. Just check the link below to gain access to them. Be sure to take full advantage of these helpful resources. Study smarter rather than harder, and you'll be well on your way to achieving real success. All right, let's dive in. Let's start with the most important divide in insurance, the line between property and liability coverage. Property insurance protects your own things, your buildings and belongings, when a covered peril damages them. Liability coverage, which the exam also calls casualty, protects you when you're legally responsible for harming someone else. Same industry, two very different jobs. Here's the cleanest way to keep them straight. Property pays first-party losses, so money flows back to you, the named insured, for damage to your own property. You're the first party, the insurer the second. Liability never pays you, it pays the third party you injured. So ask who gets the check, you or the other guy. One more foundational layer. California doesn't lump all insurance together. It sorts it by statute into classes, fire, liability, automobile, and more. For your purposes, the property world lives mostly in fire and allied lines, while casualty lives in liability. Knowing coverage is organized by legal class helps you predict which rules attach to which policy. Property itself splits into two buckets the exam tests constantly. Real property means permanent structures, the house, the warehouse, the commercial building, anything fixed to the land. Personal property means movable things, furniture, appliances, clothing, tools, inventory. A commercial policy carries one limit for the building and a separate limit for business personal property. Underneath it sits one principle you cannot forget, indemnity. California defines insurance as a contract to indemnify another against loss from a contingent or unknown event. Indemnity means restoring you to your pre-loss condition, no better and no worse. My take, nearly every tricky question tests whether a payout would leave someone richer than before. Picture a bakery. A fire chars the ovens, and that damage to the bakery's own equipment is a first-party property loss paid to the owner. Now a customer slips and breaks a wrist, and money paid to that customer is a third-party liability loss. Same fire, two coverage worlds, and the exam loves both in one question. The mistake I see most is blanking on which party gets paid under pressure. So lock in the shortcut: first party, first person, that's you and your property. Third party, some other party, that's the person you harmed. Property equals your own damage, casualty equals your legal responsibility to others. Repeat it until it's automatic. What we just covered is exactly the kind of distinction our free practice questions drill into instinct. These aren't surface level. They test the deeper who gets paid reasoning, the same way the real California exam will. Give them a try right after this video and watch how quickly the first party and third party idea locks into place. Now, insurable interest, starting with why it exists. Insurance restores people who suffer a genuine loss. It doesn't let strangers bet on disasters. So California demands you hold a real stake in whatever you insure. The rule is blunt: if the insured has no insurable interest, the contract is void. No stake, no coverage, full stop. So, what counts as a real stake? California recognizes three types of property interest: an existing interest like an owner holding title now, an inchoate interest founded on an existing one, like a mortgage lender whose claim grows from the loan, and an expectancy coupled with an existing interest like an heir set to inherit under a will. Here's where students trip, so slow down. A bare hope is not an insurable interest. If your wealthy neighbor has no will naming you and no contract with you, but you privately hope the house lands in your lap, that's pure speculation. California says a mere expectant interest not founded on an actual right cannot be insured. How much can you insure? Only up to what you'd actually lose. Your true exposure, never more. One twist the exam likes, a carrier or depositary, a moving company hauling your goods, or a warehouse storing them, can insure that property to full value even without owning it, because they're legally responsible to the owner for damage. Timing is where property and life insurance split, and examiners test it on purpose. For property, insurable interest must exist at two moments when the policy takes effect, and again when the loss occurs, not necessarily in between. For life insurance, the interest need only exist when the policy begins. Miss that contrast and you'll miss points. Let me make timing real. Someone sells their house, moves out but forgets to cancel the policy. Months later, it burns. Can they collect? No, they had no insurable interest at the time of loss, and any policy paying whether or not you hold an interest is an illegal wager, void by law. To remember the property timing rule, I use one word: bookends. You need the interest at both bookends of the story, the start and the loss, not the middle. If you memorize one thing here, make it this: property needs interest at inception and at loss, while life needs it only at inception. I know we're moving through a lot of detail, and you might wonder how to practice applying it. That's why I built those free practice questions. They take concepts like insurable interest and drop them into realistic scenarios. So instead of just recognizing definitions, you get real reps making the judgment call the exam demands. Next, one of the most heavily tested areas: how a policy decides what's covered. There are two philosophies. A named peril policy lists the exact perils it covers, and if a cause isn't on the list, you're not covered. An open peril policy, also called special form, covers every direct physical loss except those specifically excluded. Quick but important, know the word peril. A peril is the actual cause of loss: fire, wind, theft. Don't confuse it with a hazard, a condition that makes a loss more likely or severe. Now the cost logic, pure common sense. Named peril costs less because it covers less. Open peril costs more because it covers more. Named peril coverage comes in three climbing tiers: basic, broad, and special. Basic is cheapest and thinnest. It starts with three core perils: fire, and it must be a hostile fire, not the friendly one in your fireplace, plus lightning and internal explosion. Arson by the insured is never covered. Those three form your floor. Onto basic form, we bolt extended coverage, 9 more perils. Instructors memorize them with a clunky acronym, and the perils are wind, civil commotion, smoke, hail, aircraft, vehicles, volcanic eruption, explosion away from the property, and riot. Then add vandalism and malicious mischief. One nuance: wind covers interior damage only after it first breaks the exterior open. Climb to broad form and you keep everything in basic, then add 9 more perils in the phrase big affect. That's burglary damage, ice, sleet and snow, glass breakage, accidental water discharge, freezing falling objects, artificial electrical current, collapse and tearing asunder of heating systems. Broad form covers everyday mishaps, a burst pipe, a cracked window. But broad form hides fine print the exam adores. Accidental water discharge won't cover slow, continuous leakage or damage to the system itself. Falling objects won't pay interior damage unless the objects first punctures the roof or an outside wall. And both burglary and accidental discharge drop out if the building sits vacant more than 60 consecutive days. At the top sits special form, the open peril or all risk approach. Instead of listing what's covered, it covers all risks of direct physical loss, then names a short exclusion list: flood, earthquake, intentional damage, code enforcement, off-premises, power failure, and government seizure. That phrase, all risks of direct physical loss except those excluded, flags special form. Here's the part I think matters most, and students underrate it: the burden of proof flips. Under a named peril policy, you must prove your loss came from a listed peril. Under an open peril policy, the insurer must prove an exclusion applies. That shift is why special form is the broadest and priciest coverage available. One anchor fact across all three tiers: flood and earthquake are never covered by these standard forms. Not basic, not broad, not special. They're excluded everywhere and need separate policies. For memory, picture a staircase: basic on the bottom step, broad in the middle, special on top. Coverage widening and premium climbing with each step. If that policy form section felt like a lot, take a breath. That's normal. And it's why I built the free practice question bank. Seeing basic, broad, and special sorted across dozens of scenarios turns a blur into something you answer on reflex. Work through them, and the three tiers stop blurring together in your mind. Let's shift to how losses ripple outward, direct versus indirect. A direct loss is the immediate physical damage from a covered peril, an unbroken chain from cause to harm. A fire starts in a kitchen, spreads to the living room, and destroys the furniture. That scorched furniture is the direct loss, the peril acting straight on property. An indirect loss, also called consequential, is the financial fallout that follows. Same fire, but the restaurant closes 3 months for repairs, and that lost business income is the indirect loss. The exam wants the common ones: business income and lost rents, extra expense to keep operating, additional living expenses for a displaced homeowner, and rental car costs. Additional living expenses deserve a closer look because California supercharges them. While your covered home is repaired, they cover the extra cost of temporary housing, meals, and the like. And when the loss ties to a declared state of emergency, California requires this coverage run no less than 24 months with possible extensions. That 2-year floor is tested. Now, a tricky idea: concurrent causation, when two separate perils combine to cause one loss, but only one is covered. The classic scenario: an earthquake shakes a building, typically excluded, and the shaking ruptures a gas line, sparking a covered fire. So what happens when the excluded quake and covered fire hit one house? California answers head-on with a rule to tattoo on your brain: fire following earthquake is covered. Even though earthquake damage itself is excluded, fire damage that follows or is caused by that earthquake must be paid under a fire policy. The insurer can't dodge the fire claim just because a quake started it. This is heavily tested. California gives a second flavor: wildfire, then mudslide. A wildfire, often covered, burns a hillside bare. Then rains trigger a mudslide, usually excluded, and homes below are wrecked. Which peril truly caused the loss gets messy, hinging on the efficient proximate cause. My advice: don't overthink the mudslide gray area, but nail the clean fire following quake rule. Let me give you the exam lens. Concurrent causation questions almost always hand you one excluded peril and one covered peril working together. Then ask what's paid. Your move: find the covered piece and remember California forces payment of the fire portion after a quake. For messier wildfire than mudslide setups, courts hunt the efficient proximate cause. Remember, mastering material like concurrent causation takes real reps, not a single passive listen. The free practice questions in the description turn what you're learning into exam-ready instinct, especially For the California specific rules, seeing them tested a few different ways is exactly what makes them stick when it counts on test day. Time for the money question. How much does the insurer pay? Start with actual cash value, the most common method. A television bought 5 years ago is destroyed, and a comparable new one today runs $2,500. Halfway through its useful life, subtract 50% depreciation, so actual cash value is $1,250. So the formula in plain words, actual cash value equals today's replacement cost minus depreciation. Notice two things students miss. You use today's cost to replace the item, not what you paid years ago, and depreciation reflects wear, age, and obsolescence applied only to parts of a structure normally repaired or replaced over its life. Replacement cost coverage is the generous cousin. It pays to repair or replace with new property of similar kind and quality. No deduction for depreciation up to your policy limit. That's fuller indemnification, and it costs more. In California, when a policy requires you to actually rebuild, the insurer pays actual cash value first, then the rest once repairs finish. California protects you with testable time limits. An insurer can't force you to collect full replacement cost in under 12 months from the first actual cash value payment. When the loss ties to a declared state of emergency, that window stretches to no less than 36 months. California also can't deny replacement cost just for rebuilding at a new location. 2 upgrades sit above basic replacement cost, and the exam separates them by their cap. Extended replacement cost adds a cushion above your dwelling limit, a set percentage or dollar amount for when rebuilding costs spike. Guaranteed replacement cost pays the full rebuild regardless of the dwelling limit, no cap. Extended has a ceiling, guaranteed has none. Here's a sharp California nuance. A policy can't even call itself guaranteed replacement cost if it hides any maximum, no dollar cap, no percentage ceiling, no construction cost limit, nothing. The word guaranteed must mean truly no ceiling. If you spot any preset maximum in the policy, it isn't guaranteed replacement cost by California's definition, whatever the brochure claims. Last piece of valuation, building code upgrade coverage, also called ordinance and law. When you rebuild, current codes may demand costly upgrades beyond restoring what was there, which standard policies exclude. So California requires open form residential replacement cost policies to include at least 10% of the dwelling limit for code upgrades as extra coverage on top. And if a policy lacks that coverage, California makes the insurer shout it on the declarations page in bold type. This policy does not include building code upgrade coverage. To keep valuation straight, picture a ladder, actual cash value at the bottom, paying depreciated value, replacement cost paying new, then extended, then guaranteed on top. Higher up, fuller payout. As we near the finish, understanding these valuation rules is only step 1. The real payoff comes from applying them under exam conditions, which is where those free practice questions shine. They're completely free, linked in the description, and built specifically for California Property and Casualty exam success. Please don't leave them sitting there unused. Our final concept bundles California's consumer protection rules, dense with testable specifics, so stay sharp. First, the California Residential Property Insurance Disclosure. A residential policy can't be issued or renewed unless the named insured receives this disclosure, which explains the coverage types in plain language and must be printed in no less than 10-point type. The procedural details are pure exam fuel. The disclosure goes out prior to or with the application. By telephone application, the insurer must mail it within 3 business days. The agent must get the applicant's signature acknowledging receipt within 60 days, and if none returns in time, the law presumes it was provided. No signature is required at renewal. Now, the single most tested fact about this form, and it feels like a trick. The disclosure is general information only, and it's expressly not part of your policy. Only the policy's actual provisions decide whether a loss is covered and how much is paid. If a question implies the disclosure governs coverage, that's the trap. The policy governs. California protects people who lose coverage. Every residential non-renewal notice must arrive with two lifelines: the California Home Insurance Finder, an online tool organized by zip code pointing you to agents and companies who may sell you a policy, and the California Fair Plan, the insurer of last resort, providing basic property coverage when the market turns you away. Two timing numbers here trip nearly everyone, so separate them cleanly. For a renewal offer, especially one reducing limits or dropping coverage, the insurer must notify you at least 45 days before the policy expires. For a non-renewal on policies expiring on or after July 1st, 2020, the notice must come at least 75 days ahead. And if the insurer blows those deadlines, the policy auto-extends, giving the consumer breathing room instead of a sudden gap. Now ending coverage where three words get confused. Cancellation is the insurer stopping coverage mid-period. Non-renewal is the insurer declining another term. Lapse is the policy ending because the insured didn't pay the renewal premium. Hold on to the core split. Cancellation happens mid-term, while non-renewal and lapse happen at the end of the term. There's also a clean edge case, flat cancellation, where a policy is cancelled on its effective date, so no coverage ever existed and every dollar of premium comes back. Nothing was earned because nothing was ever at risk. For refunds, you need earned versus unearned premium. Written premium is the full amount charged up front. As days of coverage tick by, the insurer earns its slice, the earned premium. The rest, for days not yet provided, is unearned premium, and if a policy ends midterm, that unearned chunk belongs back in the insured's pocket. Who cancels decides how the refund is calculated, a guaranteed exam point. When the insurer cancels, the refund is pro rata. The insured gets back exactly the unused portion, no penalty. Take a 1-year $1,200 policy. If the insurer cancels at the halfway mark, 6 months are earned, so the insured gets $600 back. But when the insured cancels early, the refund turns short rate, the insurer keeping extra as a penalty for administrative cost and early exposure. Same $1,200 policy, but the insured walks at 6 months, and short rate lets the insurer keep 60%, $720. The refund is only $480, $120 less. Here's the memory hook I swear by, and it decides several questions. Insurer cancels, pro rata, the insured is made whole. Insured cancels, short rate, the insured eats a penalty. Think fairness, the party who didn't cause the cancellation shouldn't lose money. If the company pulls the plug, you get every unused dollar. If you do, you pay a small price. One more California safeguard. After a residential property policy has been in force 60 days, or immediately if a renewal, the insurer can't cancel arbitrarily. It needs one of a few grounds: non-payment of premium, conviction for a crime increasing the hazard, fraud or material misrepresentation, gross negligence raising the hazard, or physical changes making the property uninsurable. Let's pull it together, because you covered the entire foundation of California property insurance. You learned the great divide, property protecting your own things through first-party payments, liability protecting others through third-party payments. You learned insurable interest must be genuine and must exist at inception and at loss. And you learned the 3 policy tiers: basic, broad, and special. You worked through direct losses versus the indirect ripples that follow. and nail California's signature rule, fire following earthquake is covered, even when the quake isn't. You climb the valuation ladder from actual cash value through replacement cost up to guaranteed, and saw why at least 10% code upgrade coverage rides on top. Everything ties back to indemnity. Then you mastered the consumer rules, the disclosure that informs but never governs, the 45 and 75-day notice deadlines, and the refund logic where insurer cancels means pro rata and insured cancels means short rate. If it feels like a mountain of detail, that's okay, it's supposed to. Understanding beats memorizing, and you now understand the reasoning. So here's your next step. Head to the link in the description and start working those completely free practice questions, because reading builds understanding, but answering builds mastery. With the depth you gain today, plus real reps on those questions, you'll walk into the California Property and Casualty exam calm, confident, and prepared. You've got this. That brings our study guide on property basics to a close. If you'd like to practice what we just covered, check out the website linked below in the description. You'll find hundreds of free practice questions plus complete study guides covering everything we've discussed, all designed to help you review at your own pace and master this material with confidence. Hit subscribe for our next lesson, and good luck on your California Property and Casualty exam.